wonder that how about if our project you require to borrow some amount of money, do we need to consider interest expense? Again, in order for you to calculate operating cash flow, interest expense will not be considered as part of your cash outflows to compute operating cash flow. Still no. But interest expense, we will incorporate them in our discount rate that you use to compute NPV later. And you will see this concept in the next lecture note. Okay, so the rule for this moment for interest expense is that when you see interest expense, do not include in your cash flow estimation. Now, details. Okay. There will be many types of cash flows or many types of expense or revenue that I am going to explain to you. Okay, the first one is where we call sunk cost. For sunk cost, this one, please remember that sunk cost you must not put into your cash flows in the project. Okay, sunk cost you must not put into the cash flows when you calculate the cash flow for the project, no matter what year is it, year 0, year 1, year 2, year 3, whatever, you need not to put it in. Okay, what does it mean by sunk cost? One good example for sunk cost is marketing research cost. Marketing research cost. You know marketing research cost, right? Okay, for example, our company would like to invest in a new project. And our new project, we need the data regarding the project details. Okay, so we ask independent firm, the third party outside our firm to conduct the marketing research here. Okay, and that firm charge us, let's say 100,000 baht to do the marketing research. Okay, now when you talk about cash flow in year 0, so let's say when you analyze the project and you would like to put year 0 cash flow. Okay, for year 0 cash flow, remember we need to put our investment in property, plant and equipment. Okay, investment. Okay. We need to put investment in initial net operating working capital. Okay. The question is, do you need to put 100,000 to be part of your cash flow or not? Okay, the answer is no. Okay, how can you know that this one you must not put it in? Okay, now the rules for us to put any cash flow or any items in our cash flow estimation is like this. Okay, you just compare it in two different cases. Case number one, okay, the case that in case the firm do the project or invest in the project, okay, do the project. And second case, it will be the case that when the firm do not do or the firm do not invest in a project. Okay, now look at 100,000 here. Okay, think about these two cases. Okay, first one, if the firm do the project, do we need to pay 100,000? Yes, because we asked the third party to do it for us, right? We need to pay them. Okay, now when we do not do the project, so our firm finally we do not accept the project, we reject it. Do we need to pay 100,000? The answer still be yes. Okay, if you see two different cases that when we do the project, we need to pay. When we do not do the project, we still need to pay. So this one is not incremental cash flow, because incremental cash flow must be the cash flow that occur only if we do the project. If we do not do the project and we require not to pay that, so you need to put it in. Okay, this is how we do it. Okay, so sunk cost you need to pay no matter what. The definition of sunk cost, what should it be? Okay, the sunk cost must be cost or expense that the firm required to pay no matter what. No matter what means that no matter whether the firm accept or reject the project, the firm still need to pay that. So that is not part of your cash flow estimation. You call it sunk cost. Okay. Any question for sunk cost before I continue? Okay, next one. This is where we call opportunity cost. Okay, opportunity cost. What does it mean by opportunity cost? Okay, let me put it this way. Oh, uh, let me do something a little bit. Okay, need some space on that. Sorry. Okay. For opportunity cost, okay, this is not like the sunk cost. When you deal with opportunity cost, you must put it in your cash flow estimation, okay, or you must consider the opportunity cost. Okay. What does it mean by that? Let me give you one example. Let's say that the company, okay, already purchased one building, okay, many years ago, okay. It's somewhat like the firm has excess cash previously, so the firm put that excess cash to purchase the building and invest in this building. Okay. Now, since the firm regard this building as investment, so the firm itself never used this building, so the firm rent it out to someone. Okay, and let's assume that the rent revenue that the firm received from renting out this building equal to, let's say, 500,000 baht per year. Okay, and when we talk to the person or the company that rent our building, we also know that in case we still rent this building out to them, they're still willing to rent this building from us in the future. Okay, now today, okay, let's say today the firm would like to invest in a new project, and this new project require again investment in property, plant, and equipment, right? The project must situated or put this project to stay in some area in our firm, okay? And someone just remind us to the building. Oh, remember, right? The building that we purchased many years ago, okay, that we rent it to someone. Now, if we want to do this new project, we can use this building. So at this moment, the firm just thinking about we are going to use this building for this new project. So you may notice that when the firm use this building, the person who rent us will not be able to rent us any longer. Okay, so the firm will lose 500,000 rent revenue per year. Okay, now when you consider the project for this cash flow, okay, when you talk about the revenue of this project, so let's say the revenue of this project each year, let's say in year one, you expect this new project give you the revenue equal to, let's say, 3 million baht. Okay, this is what increased in terms of the revenue because of this new project. But at this moment, you may see that because we invest in this project and we use the building that we currently rent to someone else, and normally each year we generate the revenue equal to 500,000 already. So for this project, the revenue that you need to put into your project consideration must not be 3 million, but 3 million deduct the opportunity cost, okay, in terms of the revenue that we lost it in terms of the rent revenue, okay. So you minus this one, 500,000, okay. So when you calculate revenue for this project, you calculate something like net revenue that this project generate to us equal to only 2.5 million. Is it okay? This is what we call, again, remember, right? Incremental cash flow. Okay, incremental cash flow, because they are cash flow that related to our project. The first one, 3 million, this is a cash flow that generated from the project itself. It must be relevant and increment or change because of the new project. Another one, this one, even though 500,000, it is not the cash flow that generate or change because, it is not the cash flow that generated from the new project, but it is the cash flow of our firm that affected or changed by the project. So we must incorporate this one to our project cash flow as well. This is where we call opportunity cost. Okay. You may go back and look at the example that provided in the textbook. Okay. Suppose that Home Depot, right, own the land, okay, with the current market value of 2 million and can be used for the new store if it decides to build the store. So if Home Depot goes forward with that, okay, the project only 15 million will be required, not the full 17 million, because it will not need to buy the required land. Okay, actually, this is not correct. Okay, because the project will need to incorporate this one 2 million as well. So the project will be 17 million, not 15 million. Okay. Now, any question for opportunity cost before I go to the next concept? So again, let me repeat, okay? Even though this project, okay, you may notice that the firm already own this land, okay? But when you analyze the project, you analyze the project based on standalone concept. So the project as a standalone concept, you look at the project itself different or apart from the firm, okay? The firm is here. So when the firm own land and this land worth 2 million today, and this project, when you need to invest in property, plant and equipment, you invest in other things, let's say 15 million, and you also require to have land inside this project. So think about this project somewhat like purchase this land from the firm. So the project need to pay for the land 2 million as well. Initial investment must equal to 17 million in this case. Okay. Okay. Now, the next concept is where we call externalities or side effects. Okay. In terms of externalities or side effects, there are three types of externality, actually two, okay, because the last type, environmental externality, this is one kind of negative side effect, okay. So broadly, in terms of side effect, there are first, okay, negative side effect, and second one, positive side effect. Okay, let me put it this way, one positive, one negative, okay. And negative, part of it, you may talk about environmental externality here, okay, as one of the negative. Now, the first one, negative side effect. You may call this one as cannibalization or erosion. Okay. You know the word cannibal, right? Cannibal is like in Africa, you have some tribe that eat human being. Okay, so that is cannibal. So cannibalization in terms of the project is that your new project, okay, when you invest in new project, the project will eat, okay, the current, the current project. Okay. Let me give you one example. Okay, I think everyone you know P&G, Procter and Gamble company. Okay, so P&G company, they produce shampoo. Okay, in terms of shampoo, P&G will launch more than one brand of shampoo. So let's say the first time that P&G launched shampoo, oh, let me check. Okay, let me repeat. Okay, so for example, P&G company. P&G company, let's say the current position of the firm, P&G already has shampoo brand A available in the market. Okay. And shampoo brand A, okay, generate revenue. This is current revenue to P&G company. Okay. Now, this year, okay, P&G consider to invest in the new project. And it happened that the new project, P&G will produce another brand of shampoo. It also be the same product shampoo, but the brand is called, let's say, brand B. Okay. P&G expect that the revenue that come from the new shampoo B, okay, let's say equal to 10 million per year. Now, think about this one, okay? The situation may come across like this, okay? When you look at one customer, this customer, he or she usually use shampoo brand A, okay? And this person just walked to the supermarket and he or she actually intended to purchase shampoo brand A, okay? But now P&G makes two shampoo available side by side. So on the shelf in the aisle, when you imagine that when you walk in the supermarket, you will see shampoo A side by side with shampoo B, okay? And this customer, in fact, would like to buy shampoo A, but today he or she see that, oh, there exists another shampoo called shampoo B available. So this person, rather than buying shampoo A today, this person go to buy shampoo B instead. So you see the situation, right? When the firm launched the new project, what happened is that it will make the current revenue of the project that we already invest going down. Okay. In this case, if I assume that, okay, the revenue that we generate 10 million from the new project, it also cannibalize or eat up the revenue from shampoo A. In other words, it reduced revenue from shampoo A by, let's say, 1 million. So we need to put this one as cannibalization or negative externality. The revenue that we put in our project estimation for shampoo B, not 10 million, but 10 million minus 1 million. The reduction in current shampoo A revenue. Okay, so the net revenue that you need to put into your cash flow estimation is only 9 million. This is how we do it. Okay. Any question for this one? Is it okay? This is where we call cannibalization or erosion. This is negative externality or negative side effect. Okay. Okay, next one. The opposite is also true. Okay, when you have positive side effect or positive externalities, we call this one as synergy. You know synergy, right? 1 plus 1 equal to 3. This is somewhat like synergy. Okay, so what does it mean by this one? Okay. The new project. Okay. So we have the current situation again and the new project that we are going to do. Okay. When we launch the new project, yes, we get the revenue from the new project, but the new project also has the effect on the current project or the current position of the firm. The revenue of our current product also increase. Okay, so this one synergy, it helps to increase this one. For example, okay, if the current product of P&G is again shampoo A like before. Okay, the new project that when we launch the new project, it will increase the revenue of shampoo A must be conditioner A, right? Now, you may think about certain customer, okay? The customer that want to use, let's say, shampoo and conditioner together. Previously, when the firm has no new project yet, okay? No new project yet, okay? No, this one. The firm just launched only shampoo A. The customer like this will never purchase our shampoo because he or she would like to buy shampoo plus conditioner. But when we launch the new project, introduce conditioner with the same name, okay? Conditioner of A. So this person who never purchased shampoo A before may come back to be interested to purchase shampoo A because this person will buy both conditioner and shampoo A together. So the firm will not receive only the revenue increase from conditioner, but also will receive the change or increase the revenue of shampoo A as well. So you need to put these two together into your net revenue when you analyze this project, okay, the new project. This is what we do. Okay, any question for this one? Is it okay? Any question for externalities before I go to the next concept? Okay, next one. For environmental externality, this is negative externality because when the firm invest in a new project and when the project harm environment, like polluted the water, the firm will require to treat the water first. So this one will increase the cost to the firm. Okay, it's usually negative effect to the firm. Next one, allocated cost. For allocated cost, remember this one we do not put it in our cash flow estimation, okay, for allocated cost. Now, for allocated cost, usually happen because of accounting procedure like cost accounting. Okay, what it look like? Let me show you this. Okay, let's think about the firm that own a building. Okay, this is building for this firm. Okay, building, and let's assume that the building has 4 stories. Currently, the firm has 3 departments. So Department A, Department B, Department C. In other words, the firm already invests in 3 projects and each project just come up to be each department like this. Okay, this is the current situation for the firm. Now, for this firm, okay, the firm own this building, so the firm hire security guard. Okay, and let's say the firm need to pay security guard. Okay, let's say security cost equal to 120,000 per year. Okay, this is what the firm usually pay. Now, in terms of accounting procedure, okay, you would like to know the profit of each department. Okay, the profit of each department for Department C, for Department B, for Department A. Okay, you would like to know the profit for each department. So what you do? Okay, in terms of accounting, if you want to know the profit from each department, so you need to put revenue of Department C minus expense of Department C, right? Revenue of Department B minus expense of Department B. Revenue of Department A minus expense of Department A, like this, so you can get all the profit that we want. Okay. Now, you may notice that we have to think about 120,000 here because 120,000 here, it is common expense. You cannot just simply put 120,000 to be expense of project A only or the department A only. This is not correct because security guard, they help to guard all the departments there or the whole firm. So you just simply allocate 120,000 to each department. So each department, when you calculate the profit for department C, B, and A, each of them will need to take 40,000 security expense in order to calculate the correct profit amount. Get it right? This is how you allocate your expense like this. So we call this kind of thing as allocated cost. Okay. Now, this year, okay, the firm would like to invest in a new project. So when we analyze the new project, we must have revenue minus our cost, right? And then we have NOPAT that we discussed last time, NOPAT. Okay. Go down to operating cash flow finally. Okay. Now, For this new project, accountant just see that if we accept this project, the new project will turn to be department 4 or department D and will utilize the area that previously vacant on the top floor. Okay, so we use the same building. We are going to use the top floor. Now, the accountant just simply do the same process, right? So the profit for each department, including department D, okay, must come from revenue of department D minus expense for department D. And you see that, right? We have the same building, so we hire same security guard. So each year we still pay the same amount, 120,000. But this year, accountant need to allocate 120,000 to 4 departments. So they are going to put only 30,000 for department A, B, and C, okay, rather than 40,000, and put 30,000 to be part of the expense of the department like this. Now, the question is, do we need to put this one, okay, 30,000 as one of our expense or our cost when we calculate the operating cash flow? Okay, the answer is no, we do not put it there. Okay. The reason why we do not put it there because, okay, we think about the concept again, incremental cash flow. Incremental cash flow must be the cash flow that we put into our project consideration if it's changed from the previous situation of the firm. Okay, now think about it. You may call it before and after. Okay, before is like without the project versus after when the firm invests in the new project. Before the firm invests in the new project, the firm pay 120,000. Remember this amount, right? Okay. After the firm invests in the new project, the firm still pay the same amount, 120,000. So there will be no incremental cash flow or no change in any cash flow. So 30,000 allocated cost like this, do not put it in when you analyze the project in terms of financial perspective. But when you analyze like accounting point of view, the profit for department D, you need to put this one. This is where we call allocated cost. Any question for allocated cost? Or any question for extra cash flows that you need to consider when you analyze the project? We have sunk cost, opportunity cost, 2 types of side effect, and this one, allocated cost.
สมมติว่าเขาจ้างการ์ดเพิ่มนี้มันนับว่าเชนไหมครับอาจารย์
Okay, the question is, in case that the firm, okay, hire extra guard. Okay, my question is, extra guard that you hire, okay, you hire this person because of department D. So this person is not here. Okay, this person will be stay on the 4th floor. Okay, and if you hire additional guard like this, and your security cost go up to be 180,000. Okay, you are not going to put 180,000 divided by 4 and put it here. No. Okay, you need to put extra 60,000 to be here because the chain is here, 60,000, and the chain is because of yourself, and put it there. Okay, this is first situation. So yes, you may need to put it in if this is the reason. But let's put another case. Okay, again, the security cost will increase from 120 previously, increase to 180,000 because you hire another security there. But this extra security is not for the department D. Maybe previously your whole building, you hire only 2 guards, okay? Guard number 1 and guard number 2, they are not enough. So you ask the security guard company to send you another one, the 3rd person. So you need to pay extra, okay? In this case, the change that happened, it is not the change that happened because of your new project, okay? So beware, if this is a case, it is, yes, incremental cash flow. The cash flow that changed, but it will not be your relevant cash flow. It is not the cash flow that relate to your project. So even though it changed, but it is not related or relevant to your project, do not put it in. Okay. So you must give me more details about the extra cost that you hire extra security guard. Okay, right? Uh, any other question? Okay, so after this, I think we discussed already, right? MACIS, how to calculate depreciation. Okay. And we discussed how to calculate cash flows to compute NPV. We discussed that. We discussed initial investment. We discussed how to calculate operating cash flow. Okay, now let me repeat this process. For operating cash flow, okay, we calculate by first we borrow up to this row, okay, the pattern from income statement, starting from revenue minus cost, okay, or this part, okay, when you reallocate to be variable cost and non-variable cost, so you go down to operating profit or equivalent to EBIT in your accounting book, okay. And after that, we deduct tax immediately to come up with what we call NOPAT. Now, what I would like you to notice is that when you're doing this, okay, you deduct depreciation expense. And you know that this one, it is non-cash expense, right? Okay. We need to deduct this one because we want to compute the correct profit and to compute the correct tax payment. Okay, so we get something called NOPAT, similar to net income, but it is the net income without interest expense. Now, this is profit. It is not cash. So we need to adjust it. Last time we called that. We adjust NOPAT by add back depreciation. Okay. And then plus or minus change in net operating working capital and plus or minus change in non-current asset. So finally, we get operating cash flows. Okay. This is what we discussed last time. And from last time, I give you example for our project. Okay, this one. And look at year 3 here. Okay, year 3. Let's concentrate on year 2. Sorry. Let's concentrate on year 3 here. For year 3, okay, we start from the revenue here. Okay, 7,000 something minus variable cost minus non-variable cost minus depreciation. So notice that this is depreciation. And then we calculate tax. Okay, after we get operating profit, we calculate tax here. So we get NOPAT here and we add back depreciation here. Okay, and finally, we get 980 operating cash flows. Okay. Now, today, I am going to repeat the process for year 3 for you on the following slide. Okay. Now, for this slide, okay, you may notice that this is what we calculate earlier. And this is the first method for you to calculate operating cash flow. So there are two ways to calculate operating cash flows. The first method is where we call depreciation add back method. Okay, depreciation add back method. Okay, what depreciation add back method look like? Okay, so again, we compute the revenue, right? 7,000 something minus variable cost minus non-variable cost minus depreciation. So we minus this, and this. So we get operating profit equal to 875. Okay, and after that we deduct tax. So we get NOPAT equal to 525. Okay, and then we add depreciation. We add it back. That's why we called it add back. Okay, so we add back 510 here. Okay, and after that, change in net operating working capital expenditure. So finally, we get operating cash flow, 980 like before. This is what we have. The first method called depreciation add back. Okay. Now, another method that you may use to calculate operating cash flow, you may use the second method called depreciation tax shield. Okay, depreciation tax shield method. What depreciation tax shield method look like? Okay, you just simply calculate like before, but we concentrate on cash only. So we put operating revenue, okay, here. We put variable cost, non-variable cost here and here, okay? And then we do not deduct depreciation. Notice this row, okay? This row, no depreciation, okay? And then we calculate operating profit. You may call this one 1,385 as somewhat like cash operating profit or operating profit that seem to be cash because we start from revenue that we consider as cash. We deduct only expense that we actually pay in cash. So we get cash operating profit. After that, we deduct tax immediately. And you notice that the tax amount will be larger compared to 350 before. But this is correct, okay? Compute tax based on 1,385 here, okay? After you calculate tax, you subtract it out, so you get no PAT. Net operating profit after tax that you get here, it may seem to be like cash no PAT, okay? Now, you need to take into consideration your depreciation, okay? But you haven't deducted to compute the correct tax amount. If you put depreciation here, the tax amount will be correct. But tax amount here is too much because the exact tax amount here is only 350, not 554. Okay, so you need to think about if you have another expense called depreciation, how much the amount of tax that you can reduce. So we call this one as depreciation tax shield. Okay, and depreciation tax shield, the formula is you just simply use your depreciation expense multiplied by tax rate as a percent. Okay, so in our case, remember, right, our depreciation is here 510 baht this year multiplied by tax rate, in this case 40%. If you calculate this, you are going to get exactly 204. Okay, this amount 204 depreciation tax shield amount, you just add it back to your cash no PAT because 204, this is the reduction in tax in case you have another expense called depreciation to deduct above here. Okay, your effect of tax reduction will be 204, and after that you follow the same the same steps. Change in net operating working capital, capital expenditure, minus 55 and 0. So you are going to get the same operating cash flows, 980. So there are two ways for you to calculate operating cash flow like this. Any question for this one? Two of them will give you the same answer anyway, okay? Any situation you can do either way. Somehow, I just let you know the second method because for some situation, the second method may let you compute easier sometime, okay? So I put the second method for you here as well. Is it okay?
So both can be used, right?
Yes, both can be used. You are correct. If not, the question must specify to you that you must use depreciation tax shield method or you must use depreciation add back method. If not, you can use either of them. Okay, so from this one, after we calculate operating cash flow, right? Last time we calculate down to terminal cash flow and we have this slide, okay? And finally, you get all the cash flow there and calculate NPV equal to 36, I think 36,000 something, okay? This is just abbreviated, okay? This is what we discussed last time. And what we discussed up to this point last time to calculate NPV, they are where we call the project cash flow as a base case. Okay, base case. The base case or the very first case, original case. Okay, why I called it original case? Because when we estimate cash flows, okay, these are the data that we have. We have the data that units sold in year one, okay, sales price per unit in year one, variable cost in year one, and also change for each of them starting from year 1, 2, 3, and so on. Okay, these are what we forecast. Okay, this project we haven't invested yet. but we just simply look forward into the future that 1 year from now, you will be able, or we expect to sell 550 units at the price equal to 11.6. This is what we expect. Okay. And what we expect here, you may see that when we actually invest in this project, what we expect may not realize. For example, in year one, you may sell more or less than 550 units. In year one, the selling price may be more or less than this. Okay, so if we are not certain about the variable that we calculate here, okay, what happened is that when you calculate operating cash flow, okay, if your unit sold is not exactly 550, let's say more or less than this, okay, so all the numbers that follow will change. This is what we call risk in your cash flow estimation. Okay. Now, today, we are going to incorporate those risks into our cash flow estimation to calculate NPV finally. Okay. So how can we do that? Let's go to the next part. Okay. The risk analysis in capital budgeting. Okay. When we would like to analyze the risk, okay, you may analyze the risk in terms of 3 levels. First one, standalone risk. This is what we are going to look at in this lecture note. Okay, because we are going to look at the risk inside only one project or certain project or project by project. This is where we call standalone risk. But the larger level of risk is where we call within firm risk or corporate risk and market risk or beta risk. Okay, in fact, we talk about beta risk since the chapter called risk and return already. Okay, but today let's concentrate on standalone risk. Now, for standalone risk, okay, how can we incorporate risk inside our project? Okay, there are broadly 2 ways for us to do. Okay, first one is where we call sensitivity analysis, and second method is where we call scenario analysis. In the lecture note and most of the textbook, we call the third method called simulation or Monte Carlo simulation as well. But this one, I will give you a brief discussion later after I talk about scenario analysis already. Okay, now for sensitivity analysis first, so look at sensitivity analysis first. Okay, the first one here. Okay, we just ask the question that in case only one variable, okay, only one variable or only one factor change, okay, change, what will happen to our NPV? Okay, NPV will change higher or lower by how much? This is what we would like to know in terms of sensitivity analysis. Okay. Now, if you look at scenario analysis, okay, the question will be just one thing different. Okay, rather than change one variables, we change many variable at once. Okay, so many variable or many factors change. Okay, what will happen to our NPV? Okay, this is the different equation, just that the rest are the same. Okay, now let's look at the first one, sensitivity analysis. How we do that, I already conduct that for you. Okay, for sensitivity analysis on the next slide, okay, I just change, okay, the unit sold. Remember, right? The unit sold, okay, the unit sold base case equal to 550 units. This is what we know. Okay, and now, okay, I just change from the base case. You see this one, right? Deviation from the base case by minus 30%. Okay, so I just change by reduce it by 30%. So from 550, we just reduce it to 385 units. The unit sold in year one. Okay, if we change that, what will be our new NPV? The answer is this one, minus 1,791. Okay, let me show you how to do this briefly. Okay, so you want to change the first year unit sold 550 to be 385. Okay, so you go back there, here, okay, and you change this number from 550 to be, okay, 385. Okay, but the growth rate still be the same. Okay, the growth rate that you put it earlier your growth rate is here equal to 4%. So the following year, okay, year 2 will increase not from 550, but increase from 385 by 4%. Okay, so increase to be here. So all the units sold will be changed. Okay. Now remember, sensitivity analysis, you change only one factor. The rest will be the same. This one, and this one. Sales price will be the same. Variable cost will be the same. Non-variable cost still be the same. Okay. So you need to have these two amount, the new one. Okay, for all of them. So you see the work, right? So you repeat the whole process here, calculate the new one. So your operating profit will be another number, and you calculate to be another new OCF. Okay. And after that, you repeat the process until you get here, new NPV. Okay. And your new NPV will go to equal to minus, okay, 1,791 finally. This is how we conduct sensitivity analysis. And you must repeat the process for each factor one by one, okay? And not only this, right? When we go the other way around, so we increase by 30%. So from 550, I increase it by 30% to be 715 units for the first year, okay? So I repeat the whole process and I get new NPV equal to this one, 1,863. Okay, and I also change other one like price, okay, like variable cost. When you change variable cost, beware. If you change variable cost, so it means that when you go back here, okay, so you change this one, the variable cost here, so you change this row, or you change the first one, okay. So the rest must be the same. You must use 550 like before. Okay, you cannot use 385. You must go back to use original case 550 units, 11.6 and 2000. And only this one changed because of the sensitivity analysis. And finally, when you calculate all of that, you get the answer equal to this one, minus 2083 when you change your variable cost per unit in the first year. Okay, so in order for you to do the sensitivity analysis, okay, and in order for you to get the whole table that I provided to you here, how many times that you need to repeat the whole process? Twice for equipment, twice for price, right? This one also, this one also, this one, and for cost of capital as well. So you need to repeat the process another 12 rounds, okay, including the first round that you calculate for base case. Okay, so in order for you to get this table correct, you need to repeat 13 rounds altogether like this. So you comes up with sensitivity analysis. Okay. Now, for sensitivity analysis, why we need to do that? We need to do that because after we calculate and we get all the answers here like this, okay, you can just answer me that for all the factors here, okay, equipment, price, unit, variable cost, non-variable cost, cost of capital there, or discount rate there, okay? Which variable is the most crucial to the firm or the most dangerous to, which variable is the most dangerous or the most crucial to the project, not the firm, to the project, okay? Now, the answer is the price. Because you change all the variable by the certain percentage, they are changed by increase or decrease by 30% as well, right? Okay, but the variable that change your NPV the most will be the factor that is the most dangerous to your project or very crucial to your project. On the other hand, okay, you may see that WACC, right? Variable cost, oh, both of them, they are also important because the change is in the opposite direction, negative here, okay? So all variable here, 6 of them, they are important for the project, but the most important one is the price because it will change your NPV the most. But in case that when you change the variable up and down by 30% like this, and NPV that you get 3 of this, okay, or actually up and down here, okay, if NPV up and down here still be positive, both of them, so that variable will not important to this project that much. This is what we get finally from our sensitivity analysis. Okay, any question for sensitivity analysis like this? Okay, this is the first method only. Okay, now from the result of sensitivity analysis, all the numbers there. Okay, you can draw a graph, two types of graph here. Okay, this is one of them. This is another one of them. Tornado diagram. The next type of analysis is where we call scenario analysis. Okay, for scenario analysis, we will change more than one factors at the same time that I discussed earlier. So look at this one. Okay, for the base case, this is the original data that we have. If you notice this one, the data in this column will be actually the same of what we have earlier. But now you can see that we are going to change more than one factor at the same time. And we call each case as, let's say, best case, worst case, like this. Okay. So for worst case, we reduce units sold. Okay. We also reduce the sales price. Okay. We increase the variable price. We increase non-variable price, non-variable cost here. Okay. So we change more than one variable, including the growth rate. Okay, including the growth rate for the unit sold, but we still use the same growth rate for the rest three. Okay, after you have that, you just compute the new NPV called worst case NPV, and you also conduct the similar process for the best case like this. Okay, and you get the best case NPV here, 13,379 in best case. Okay, for each case, we also have what we call the probability. Okay, so we assign the probability of each scenario here. Sorry, the probability of each scenario here. Okay, the base case, the probability will be 50% of the time. The worst case, the probability is like 25% of the time. The best case, another 25% of the time. Okay, so the cash flow that we get from case by case, best case, worst case, this is what we have. And we have NPV that I showed you earlier like this. Okay, so now we are going to compute the new variable called expected NPV or ENPV. Okay, how we calculate expected NPV? Okay, let me put it here. For expected NPV, it just comes from the probability multiplied by NPV of each case. So 50% we are going to get like base case. Another 25% that we are going to get NPV like worst case, plus another probability 25% that we are going to get NPV like best case. And after that, we get new NPV, and we call this one expected NPV. In this case, 1,901. Okay, and in fact, when we analyze the project, we say accept or reject the project, we are going to compare with 0. And we compare 0 with expected NPV, not the base case NPV that we discussed last time. This is the whole process for calculate the cash flow like this. Okay, so after you get the average or expected NPV, you may calculate other two statistical properties that we studied earlier, standard deviation and also coefficients of variation finally as well. Okay. Okay, any question for the cash flow estimation, this chapter and risk analysis that I add on today?
Is the probability of the best case and worst case is fixed?
No. For the probability, okay. In fact, there will be no theory for you to put in the probability. So normally, the analyst like yourself, if you analyze this project, you need to assign the probability by yourself. Okay, this is the probability. If you have more cases like this, so you need to allocate probability to other cases as well, maybe 5 or 6 cases. Okay, and more than that, if you do more cases like this, okay, if you do like 1,000 cases or 10,000 cases, okay, you actually conduct lots of scenario analysis, but we do not call them scenario analysis. We call them as simulation. Okay, so previously I say that simulation is one type of scenario analysis, but you will do more than that. And most of the time, the simulation, you need the help of a computerized spreadsheet to help you to do that. Okay, any other question for cash flow estimation and risk analysis here? Okay, right? Okay. Then let's get into the next lecture note, cost of capital. Okay. So let me put this one away. No. Now, the linkage for cost of capital chapter is like this. At this moment, I think you know that when we conduct the process of capital budgeting, okay, you have the project, right? -1 operating cash flow for last year plus criminal cash flow. Okay, like this. Okay, and we compute NPV. Until last year. Let me put it this way. Okay. So at this moment, you know how to compute operating cash flow or all the cash flows for the project from last lecture note. And you know how to compute NPV from last 2 lecture notes. Okay. Now, in this lecture note, cost of capital, we are going to talk about the discount rate here. Okay. What must be the discount rate to calculate NPV like this? Now, how can we come up with a certain discount rate or required return for a project? Okay, think about it this way. Okay, for initial investment in year 0, okay, broadly we invest in 2 things. Okay, property, plant, and equipment, right, for the new projects, and also initial net operating working capital. There are 2 of that we need to invest. Okay, when you invest in these 2 things, okay, PPE and net operating working capital, okay, think about your statement of financial position. Okay. When you invest in a new project, what happened to you is that if these 2, you require, let's say, 10 million, okay? So according to statement of financial position, you must have cash equal to 10 million first. And then you use this amount of cash to purchase, okay, property, plant, and equipment for your new project, and also net operating working capital. And 2 of them will worth 10 million. So you use cash to invest in this one. Okay, this one come from your new project. Now, today, okay, we are going to look at one step before that. Okay, so go back here. How can you get cash 10 million to purchase these 2? Okay, according to statement of financial position, you know that 2 sides here give us 2 different decisions. On the left-hand side here, in finance world, we call it investing decision, right? That we talk about since the first lecture note. Okay. And on the right-hand side, there are where we call financing decision. Okay, financing decision. So in order for the firm to get cash equal to 10 million to purchase new asset for the new project, okay, the firm must get the financing from the right-hand side. The financing on the right-hand side, broadly, there are 2 types. You just borrow some amount of money as liabilities or debt, okay, or you get from common stock or common share, okay, and some firm you may have preferred share as well in the middle, okay. Now let me assume this, that when you want to invest 10 million here, okay, in case that you just borrow from the bank, so you just get bank loan and you get 10 million, okay, so nothing come from preferred stock and common stock like this, okay. And when you borrow from the bank say that, okay, you borrow from me 10 million, right? Okay, you must pay me the interest. You must pay the interest to the bank, let's say 7%. Okay. Now you can see that the source of fund that coming in, you get financing 10 million from the cost or the interest rate that you require to pay 7%. So you borrow 10 million, you need to return 10 million plus 7% each year, right? This is what we see from the bank loan. Okay. So when you go back to analyze this project, when you calculate IRR, okay, your return from this project must be at least equal to 7%, the interest that the bank charge from us, right? If you cannot invest in the project that cannot generate at least 7%, you will not have enough cash to pay back to the bank, okay? And from this one, all the interest or the required return here, the required return or expected return in the project here, you must use what? 7% as well, okay? To discount and compute NPV like this. This is a very simple case because we just talk about the whole 10 million come from only from the bank loan, okay? So this is what we have. Now, what does it mean by 7% interest rate that bank charge us? Okay, this is interest that the bank charge equal to 7%. Okay, what does it mean? Okay, in terms of the bank perspective, okay, 7% here is the return to the bank. Get the point, right? Because the bank lent us the money 10 million and the bank would like to get back original principal 10 million plus the return 7%. That's why the bank charged us 7% interest rate like this. So the same percentage here, okay? 7%, it is the return in the perspective of the bank, but the same 7% in the perspective of a company or this company, okay? It is the cost. Am I correct? The company has the cost to pay 7% per year for 10 million that the firm borrow. This is cost equal to 7% per year. Okay? Same number, but two different perspective. Okay. Now, let's go to actual situation. Okay. The actual situation is that when the firm would like to get cash 10 million that we discussed earlier, previously, we just simply assume that the firm can just simply borrow from the bank only 10 million, right? Okay. And in reality, you cannot find any bank that will lend you the whole amount that you would like to invest in the project like this. Okay. The bank will lend you only partial of your total investment. So this is not the real situation. Okay. So the actual situation that we usually come across, okay, when you want to get cash equal to 10 million like this, and you invest in the new asset for the project later on, okay, 10 million that you get, you must get it from three sources of fund providers, okay, whom we call debt holders, okay, preferred stockholders, and common equity holders like this, okay. And three of them, okay, may just bring in the money at the different proportion. For example, out of 10 million total that you need, you may borrow from the debt only 2 million. Okay, preferred stock maybe 3 million, common equity another 5 million, total up to be 10 million like this. Okay, now for all of these, you can just translate them to be wage. Is that right? So when you get 2 million out of 10 million, so the wage that you bring in terms of the debt equal to 20%. The wage that you bring in terms of preferred share is 30% and 50% for equity like this. Okay. Now, let's see each of them. Okay. When the bank lend you the money, the bank charge you the interest rate. Okay. And this one is your cost. So I call this one cost of debt. By short, we call it KD, cost of debt. Okay. Not only bank loan, the firm may get the money from borrowing, not from the bank. The firm may issue bond. Okay. When the firm issue bond, remember, the bondholders, when they invest with us, this is what we discussed in security valuation chapter. Okay, the firm also required to pay the return to bondholders called yield to maturity, right? So yield to maturity is the return to bondholders. At the same time, you may look at this same percentage as cost of debt. Okay, it is the cost that the firm issue bond, and the firm must pay the return to bondholders equal to yield to maturity. So yield to maturity is the cost of debt to the firm as well. Okay. Now, for preferred share, okay, the return for preferred share is KP. The return for common share is KS. Okay, but let me put KS and KE together. I will distinguish them later on. Okay, so after you have that, three of that, okay, you may notice that cost of debt usually be lower than cost of preferred share and usually be lower than cost of common equity. Because when you think about investors in our firm, we have debt holders, we have preferred stockholders, we have common stockholders. Okay, three of them. Investor who take the lowest risk must be the debtor or the creditor. Sorry, the creditor, not debtor, the creditor. Because the creditor or the bank or the bondholders will take the money first. Okay, they get the highest priority among these three. So yield to maturity or cost of debt must be the lowest. Preferred share is the next one that riskier. But common share, you are the residual cash flow receiver that we talk about since lecture note number 1. So the return or the cost will increase like this from the debt to equity. When three of them are not the same, cost of debt is not equal to cost of preferred share, and cost of preferred share and cost of debt not equal to cost of equity like this. Okay, how can we just simply get three of them and just reduce three of them to just one single number? Okay, so we use wage multiplied by cost of debt. We use wage of preferred share multiplied by cost of preferred share. We use wage of equity multiplied by cost of equity, and we sum them up. So we get one certain number called weighted average cost of capital like this. Okay, so from here, okay, I can rewrite the weighted average cost of capital on horizon basis like this. So WACC, weighted average cost of capital, or WACC, just equal to, okay, wage of debt multiplied by cost of debt plus wage of preferred share multiplied by cost of preferred share plus wage of equity multiplied by cost of common equity, either KS or KE. I will distinguish this one later. Okay, this is the formula in this lecture note, the new one that you just have at this moment. Okay, for your information, in this lecture note, you are going to have only two new equations. This is one of them. Okay, now for cost of debt, you need to know something more about cost of debt. For cost of debt itself, okay, the debt itself has one benefit compared to preferred share and common share that preferred share and common share never have. That benefit is interest tax shield. Remember, right? We talked about it. Interest tax shield is the benefit that when you borrow some amount of money, you pay interest expense, and interest expense will reduce tax for you. Okay, so the tax benefit is here as well. KD is where we call before tax cost of debt. But the actual tax benefit that we get, the cost of debt that the firm pay will be lower than that. So we multiply by 1 minus tax rate here. Okay, this is the only term that appear multiplied by 1 minus tax rate or after tax factor. Okay, and you may not have this one for preferred share and common share because preferred share and common share give back the dividends, and dividends never have any tax effect. Okay, in case you remember our security valuation chapter, I have one table compare the tax benefit to you or tax deductibility to you, and only that has it. Okay, and when you talk about the whole term here, okay, this one, you call this one as after tax cost of debt. Now, The agreement in general is that you see before tax is in parentheses, right? Okay. So when the question just simply say that, okay, cost of debt equal to 10% like this, okay? If the question just simply say like this, you must know by yourself that the question just simply give you cost of debt before tax or only KD. So in general, when you are given cost of debt, always remember you get before tax cost of debt. So you need to multiply 1 minus tax rate. Now, in case that the situation give you after tax cost of debt, it must say right away that after tax cost of debt equal to like 7%. Yes. Okay, this is the rule. So after you have that, you use this rate to compare to IRR again. Okay, so you are going to accept the project when IRR is greater than or equal to WACC or cost of capital. Okay, you are going to accept the project. Or when you go back to our NPV calculation, okay, the discount rate that you use to discount the cash flow here in your NPV here, okay, so you just simply change to cost of capital 1 plus WACC 1, okay, 1 plus WACC to power of n like this. This is the concept of cost of capital. Any question for this one at this moment before we take a break? Right? Okay, so let's take a break at this moment, like 15 minutes. Okay, I will come back.